Okay, folks, welcome back. This is our midweek review for February 19th, 2020. It's our weekly chart of the dollar index, and I want you to take a look at what we've seen so far for this year. And we've had a nice run up above the old highs here, and I drew your attention, reminding the folks that have been with me for a while, at least for the last 6 months or so. We've been monitoring this volume imbalance in here. So just to add the few things I want to talk about on the weekly, the close of this candle right here, this down close candle, that close is 99.98, and the close on this candle is 99.19. Now it's not important because we have since traded above that here. So what we're doing is we're anticipating this area, this little segment of price action, and I'm going to highlight exactly what I'm looking at. I know sometimes when I refer to this particular portion of price action, it's confusing to some of you. Okay, so you can see the section in price action. So when I refer to the volume imbalance, it's this particular area right in here that's shaded in, okay? And it's the absence of any candle body. Okay, so otherwise, if these wicks weren't here and here, it would look like a normal gap. And that's what I'd call a volume imbalance. Now, you can't really find anything written about it because this is my creation. It's my way of determining an area where price will want to revisit to rebalance it. Now, by any other definition, okay, of anybody out there that looks at supposed liquidity voids or imbalances or things like that that go by different names, they don't talk about this. They wouldn't look at this as a inefficiency, but it absolutely is an inefficiency. Okay, it doesn't spend enough time in here, so that's the reason why the bodies are absent. Now, yes, price shows a run up into this level and a price run down into this level here on this candle, and they overlap, but the fact that there's no bodies on this particular time frame indicates to me what would be expected in the future, and as we're seeing now, the bodies are actually being delivered inside of this area. So I'll kind of like draw another line here to help illustrate the point. Okay, so between this line here and this line here, there's been a body that's been delivered. So if we close this week with this at this level or a little bit higher, it's filled in, whereas even this area here was a wick. It hasn't done its job as efficiently as it should have by leaving a body in there between these two price points. Okay, so that's the ICT volume imbalance. All right, so I want you to take a look at the really nice movement we've had from the area down here. We looked for bullishness and then making a potential run up into here, and mentioning throughout the process that if we do get above specific levels, we would return back to this weekly level here. Okay, so I want to kind of like close that in as like a bookend on that topic and that discussion. Okay, so here's our daily chart on the dollar index. You can see that we've again had a really stunning run from here all the way up to the old high. Now the old high was breached today, and I'm going to talk a little bit about that when we get into the 15-minute time frame. I'm going to drop down into a 5-minute to kind of like build a understanding about price action. As I mentioned today on Twitter, I tweeted a consistency recipe, kind of like being facetious, indicating specific things that will provide you the catalyst for very consistent New York setups. Now, it's not limited to just that. Okay, there's other ways of using what I teach, but by itself, that's what I outlined, and then I'll show you what I meant by that in price action. Okay, coupling the dollar and cable. So we have a little bit more upside to go before we get to that 99.98. It'll be interesting tomorrow because we have the economic calendar suggesting there may be some volatility on euro. I'd like to see it complete its downside objective, which is its weekly discount array, as we'll talk about when we get to euro next. But I want to talk about the reasons why I expected the large ranges in here. As I mentioned on the weekend review, before we started our week. And on Saturday, I mentioned that when we were sitting here, we want to see large candles come in. Okay, so it was going to move aggressively. Part of that will be discussed in greater detail as a charter member when we get into the later portions of the price action models trading plans, because there's things that have to be directly related to a price action model and or a concept that's being utilized for that model. So I don't want to jump the gun for some of you, and I know some of you are shaking your head and hissing already. Oh, you're keeping it from us. No, you have to go through the same process like everyone else does, but you will get it. But I will say this. When the candles are small in here, see how they're very, very small bodied relative to like a candle here, and we had one nice big one here, medium sized one in here, and then they started shrinking, created a bullish order block. We traded down into it, had a nice move here. But on the heels of that, as we were approaching our objectives, we want to anticipate speed and magnitude. Okay, in other words, distance. And since these candles that we're looking at on a daily chart comprise the 24-hour cycle for this dollar index, we would anticipate the candles to become large and up close candles. So here it is again being delivered. So it's really fun seeing the new folks that are in here. I just want to kind of like spend a minute here. And yes, it does sound like I'm beating my chest and stroking my ego, but I'm not. I really want to tell you what helps me as an educator. Okay, when I get to see messages from you folks that are new and you're seeing these things for the first time, I understand when you first sign up, it's a little scary because you don't know what you're getting. You don't know if I'm scamming you or if other people are really just me sock puppeting. Like I got 30,000 sock puppets on Twitter. When you see me do these things and I explain them before they happen and to the detail and degree that I refer to specific things, and then it happens in the chart, that moment when you see it and all the doubt goes away and you start saying to yourself, he's been real the whole time. I have been. And when I get messages from folks that are new and they do that, that is such an encouragement to me, because being on Twitter sometimes is rather draining. And truth be told, as I mentioned, some of the people I do talk to on the side that are in this mentorship, this is my last year on Twitter. It's run its course. I'm done with it. I'll keep the Twitter there because everybody will jump on it, because I gave up my old handle and some goober has it now and pretended to be me for a little while. But long and short, I just want to thank you for taking the time to shoot me messages, and some of you sending me tweets saying that you're new and you're seeing everything that you've heard other people talk about but thought it was BS or made up or contrived. It's such an encouragement to me, because that's the kind of stuff that fuels me. I mean, everybody that's charter member, I appreciate everyone that says the stuff that they say and encouragement's there, but it's the new blood that comes in, okay? Because the charter people, they already seen this. People have been here for 8 months, 9 months. They've already seen this. The novelty's worn off in a way, I guess. The new folks that come in, when you see this for the first time, I get to relive that same moment all over again when you tell me that you are having that experience as well. So when you see it and you're just like, wow, this is really exactly like he's explaining it. That moment, I can remember the very times that I had those moments. And it's an encouragement. It's a way for me to reflect on things. And it's amazing how they come to me just at the right time, because like anybody else, I get moments of depression. I get moments of discouragement. I have real things going on in my family life that are really draining. And I just want to thank you all for doing that. Okay. And I'm not going to beat up anymore, but we had large range candles delivered on the daily chart, and we ran out our high. So we did go across our rejection block, which is the highest up close candle, the close price. That's the rejection block. So when it trades through that, we expect that to be a premium array. But I already mentioned that we were going to go through that and target this old high and then this old weekly volume imbalance. So do we need the retrace in here? I'd like to see it maintain its momentum. I'd like to see that be carried over into tomorrow and Friday until we get to the volume imbalance. I'm going to put this out there right now. As soon as we get to the volume imbalance and it probably pokes into the full $1 mark, I am on the sidelines with no opinion. Because basically we called the first quarter's move. Okay, I mean, the fact that we did it down here and then right in here, I mean, first quarter was a slam dunk. I mean, this is what you want to see in your analysis, and when it comes to pass, it's really, really encouraging. So we'll be waiting for the second quarter, which we still have like weeks before that actually begins. So we got to get through March to begin quarter two, but quarter one has been delivered. Okay, so once we get to 99.98, let's say it that way. Okay, when it gets to that price level, and I'm expecting it to touch the full $1 mark, then it would close the books on quarter one with ICT. So that quarterly shift and all the analysis that go along with it, you guys got to go back and revisit all of the weekly reviews, because it'll help you pick out certain things I've said and some of the things that were at the time feeling like very long-winded, like all my videos seem like when you're first listening to them. But when you see everything I talk about happen, then all of a sudden it's more encouraging for you to go back and say, okay, maybe he said something here that I missed. And then that's where you learn, because then you see the things in your chart. It's not, the boardwalk shuffle where I'm, moving the cards around and trying to keep your attention somewhere else and pretending this stuff works. I'm showing you that it works. But then you'll go back and you'll watch these videos again, and you'll retain more of the directions and instructions that I put in those videos. Whereas the first time you watch it, it's like, okay, just get me to the point where you're saying where it's going to go next, not why, not the things that led to it. Okay. So we're looking for that continuation. Now, if we do retrace tomorrow or Friday, then that becomes a struggle for 99.98 to a full $1 mark, because we can come back down below and get into this order block here again as a reclaimed order block, and I don't like that. I don't like that at all. I want to see it maintain its momentum. But if we come back down in here and touch the top of this candle at 99.20, that's 99.21 for the high, but I'm going to call it 99.20 institutional. So if we get back to that level, we want to see that defended. We don't want to see it break below that. Can it spike through that on intraday volatility, on some kind of a news driver, and then whip back above it? Yes. But again, that's not what I want to see. I want to see it maintain what it has here and then just drive on into that 99.98 to full $1 mark. All right, so let's drop into an hourly chart. Okay, so here's our hourly, and I'm not going to say too much about this time frame because it's pretty obvious as to what it is. It's a steady pull on price up into our old high. At this chart, on this chart rather, what you want to do is on your chart, go through, and every time we have a swing high and a low, you want to be studying how the swing lows are being supported by old down close candles, and they're running through old swing highs and the up close candles that make up the swing high. So what that's illustrating is institutional order flow. So when we have that in price action, it supports the idea, which is basically what I'm trying to teach you by experience and week by week exposure to it, by me telling you what I see in the charts, why I expect to see them unfold. And it's just basically looking for liquidity pool to draw on liquidity, order blocks, and imbalances. Okay, so I'm not using everything. Notice that we don't ever bring in COT. And I know some of you are saying, can you bring in COT, or can you draw a parallel to what's going on in COT with the dollar index, or do you use COT with the dollar index? I don't ever use COT data on the dollar index, and it's because it's skewed. So I don't look at that. I look at the relationships with the commitment traders with other pairs. Okay, for like instance, the British pound or the Canadian dollar, Australian dollar, and the euro futures. And I look at those independently, and then whatever I would see in their COT data, it would just be a mirror image in my mind what would be seen in the dollar. Because the dollar is so thinly traded, it doesn't have as much volume in this versus like the euro. Okay, there's more volume and more actual trading going on in the euro futures than it is the dollar futures. And that's the reason why I don't do anything with the CO2 data with the dollar index. But the point is I don't try to put a whole lot of things in to my weekly analysis because, number one, I'm not trying to do everything for all of you, because you're only going to learn this by going through it and doing it yourself independently. Now, admittedly, there's a lot of things that's going on behind the scenes that's supporting my opinion of why I'm saying certain things. And yes, COT and other pairs, as I mentioned just a moment ago, are attributing factors to those supporting things, okay, or facets to my opinion being formed. So just know that there is a lot of things being left out of the weekly analysis, not because I don't want you to learn it, not because it's a secret, because it's taught in the core content. Each month there's more stuff. But these videos would literally take me 4 to 5 hours to go through everything like that all the time. And I don't have the time to do that. And it sounds like I'm blowing it off, but it's the truth. You don't need it. Clearly, you don't need it. Now, when we have the analysis broken down like this, what I've promised you, and this is what you get, is I give you my opinion midweek and before the week begins on the next week. So you're getting the middle of the road, if you will, after Monday, Tuesday, and Wednesday. So that weekly high or low is usually in place. And or at the end of the week, before the new week starts, I give you my opinion of what's going to happen. So I'm giving you the directional bias, the thought process, the pitfalls that you're going to probably step into if you don't listen to me, the drivers that are on the economic calendar. You guys are at this point now, you should be just like you see me now in the last two videos. I'm not doing it anymore. I put it up there. You guys can see it. You should be making notations as to what you see in that schedule in terms of what pair and what level of intensity, whether it's a high impact red, medium impact, orange. All those things, are going to help you focus on what trade per week and what currency that you're going to be waiting to trade on. And then coupling that with when you learn the weekly profiles, it'll all start coming together. But just as a passing remark as we go to the next time frame, the hourly chart on the dollar, I want you to just mainly mark up your own charts and look at how all the down close candles or bullish order blocks are supporting price when it retraces lower. It's having little difficulty, breaking above short-term highs. And when it comes back down, it's rebalancing and finding an ability to go higher with really no resistance whatsoever. All right, so let's drop into the 15-minute time frame. Wrap this up for the dollar. And here we have the 15-minute time frame. And I want you to take a look at this particular session here. And this is the New York session. And we're going to mark out 7 o'clock in the morning, New York open. All right, and then we're going to mark out to 10 o'clock in the morning. So there's our morning session, bread and butter boundaries. Okay, and I'm going to zoom in here. And I want you to take a look at between these two vertical lines. This delineates the New York open, okay, or the sweet spot, if you will. When the setup forms for New York, it's in between these particular time frames. The reason why that's 10 o'clock and not 9 o'clock, because sometimes there's a report that comes out at 9:30 or 9:45 or 10 o'clock, and it's going to be an impact on the marketplace. So that's why we have the elongated kill zone. Normally, if there is no 10 o'clock news or late New York after some like the 9 o'clock in the morning news, if there's nothing after 9 o'clock in the morning for news, then your kill zone will just be refined to just 9 o'clock and 7, so 7 to 9, and it makes it easier to anticipate. But you're going to find that most of those setups are still forming between 7 o'clock and 9 o'clock anyway. But you want to have this noted on your chart like that, 10 o'clock, 7 to 10. Between these two price points, you're going to see either a retracement that drops down that anchors to a London low, or there will be a low form in between these two and then retrace back down into it again. Okay, and in other words, what I mean by that is this low here to this low, how we retrace back inside from this swing low all the way up to this swing high down to this swing low. That type of retracement here may actually be inside or between these two specific time frames, okay, or hours of the day, between 7 o'clock in the morning and 10 o'clock in the morning, New York time. Now, very easy. Everyone wants to know what time everything is. I got new folks asking. If you look at the time setting down here, okay, if you click on that, just click your trading view to UTC-5 and it'll say New York. If you click on that, our charts will be synced. Okay, so you'll see everything. When I say a specific time, right away you'll know what it looks like on your chart. And then you just got to figure out what that means for your local time. Makes it a whole lot easier in that regards. I'm very appreciative of TradingView because we've always had a problem communicating to members all around the world, even when we were using Forex Ltd as a demo account. And then we rolled into all the other brokers we tried to use because they had dollar index and allowed us to look at the same charts. It still created a problem in terms of time. Converting that to wherever you are. And I've always tried to avoid that conversation because not only does it confuse me, and like I said, I'm not a mental giant. Okay, I've never claimed to be a mental giant. I'm just really lucky trading. But when we look at time, it just has been a barrier for me to bridge to some people. And this way, if you have it set to this, again, it's this one right here. If you have that setting on TradingView, you'll have everything you need. So that way, when you see my times that are being marked on my chart, it'll match. And then you'll have to figure out what that is for your local time. And it may not work for you. You may be working, or you may need to be sleeping at that time, or you may have school, or whatever it is. That's for you to figure out. But nonetheless, this swing down, okay, when we're bullish, remember the process. We were looking for a run above the old daily high, which is at 99.67, and then the high on the weekly back here, 99.98. Okay, so with that, we're looking for, let me make this a little bit, spread this like this. Okay, so yes, we have the London session low, and then we have the high that's formed right before the New York session kill zone, which is between these two vertical lines. And then there's a retracement. It retraces down into an order block. Okay, so we have the low to high, we retrace back down into an order block, and we also, right before the order block, we have a swing low. Okay, right here. See that? So if we were, and I'm only putting this up here just to show you the equilibrium. So we have the low to high. Here's the 50 level. So it has to get to that level or below it to trade to what? A discount. It does. So we have a discount market in a bullish order block when the market's predisposed to go higher. Right away, you've already fleshed out 80% of the equation. So we have the order block price trade down to that. Now, what we have here is two things. We have the directional bias that's been already given to you since last weekend, going into this week. We know a level of liquidity that it's going to draw to, which is that old daily high. Okay, and now 7 o'clock to 10 o'clock in the morning, New York. What are we looking for? Expansion on the upside. Well, do we have a London low? Yes. So we want to see this low, and I want you to think about it like this. From this low all the way through the New York session kill zone, you're anticipating price action to move up. Okay? You expect to see all this price action move like that. Now, when it starts to get towards the end of the New York kill zone, you have the profit taking portion of the day, which is 10 o'clock to noon, which can expand to 1 o'clock, but we're just going to stick with the easy one here. So what this means is your setups are framed relative to time and price And you'll see there is a specific amount of symmetry that takes place when you start viewing price like this. And I'm just going to elongate that a little bit because we don't need that weekly objective right now. So we have the order block, price trades in here. So now, what does that mean for the dollar? Okay, clearly it's going to go higher. That's what it implies. So our expectation is we want to see price go higher, and then every down close candle. Okay, this is ICT, institutional order flow. Okay, this is what those guys from Goldman Sachs come here to learn. Okay, this is what they're learning. All right, so you're going to take a level here. All right, and then, all right, so from this point here, okay, right here, when price starts to expand up, every down close candle, when price retraces down into it, it should support price. Does it do it here? Yes. Okay. Over here, we have another down close candle, and price moves away from it. Here, when it comes back down into it, does it support price? Yes. Okay. Down close candle, does it support price? Yes. Rallies again. So it creates the opportunity for you to get out. Now, obviously it's still trading. We have a couple hours left for this particular day. This is enough to get very close to the daily high. Now, what we've had is bullish order block here inside the kill zone, trading with the directional bias I've given you, which is bullish, trading to a level of liquidity, which is the old daily high right here. Now we have the element of time. Okay, so if take this line here and draw it down imaginary to here, it's that high right there. So above that old daily high, which is 99.67. So we're looking at two facets here. Time, okay, it's going to create a low between these two vertical lines that we're trying to buy. You have to look at what London has done. It started to move higher and it retraces. In between these vertical lines, you're looking for a retracement back to an order block or a fair value gap, but it has to be in the form of a discount. So when you run your fib over it, what you're doing is you're getting the equilibrium. So it has to trade to that or below it. I prefer to look for a discount array in the form of a bullish order block or a bullish fair value gap or an old low to run out. When it's retracing like this, I don't want to see it dip down that far to run those sell stops. Okay, I don't want to see it do that because it's already done that in London from over here. So that aspect has already done its job. So this low should be reactionary in such a way where once it runs away, any retracement, the first retracement it gets, it's going to be energetic. And you can see the most energy is when it retraces during the New York kill zone to a bullish order block that's inside of the London swing. Okay. So the tweet I gave was the very facetious title, Consistency Recipe. And what you're doing is what I just outlined right here. And as I mentioned on Saturday, this is what forms every single day. Now, not every single pair will have this, but using the dollar index as your barometer, you can go through the pairs, okay, and look for the opposite of this type of thing and supporting narrative. That means a bearish sell scenario, either in the euro or cable or Aussie dollar or New Zealand dollar. Okay, you get what I'm saying. So in reference to time, here's your element of time and price. So at the end of the New York kill zone to noon, in this area above the old daily high, so you can be a buyer of dollar, which would be bearish foreign currency, and hold on to your shorts in foreign currency, either in euro or the pairs I just mentioned, cable, until we get to this scenario here. Because at that point, you're in an area where it's going to possibly create the opposite end of the daily range and either stall or retrace on you. So you want to get out at the optimal exit points, which would be in relationship to time, which is this area here between 10 o'clock and noon, New York time, or 1 o'clock in the afternoon. It can extend all the way to here, okay? But we didn't make it until a slightly higher high here at 2 o'clock, which is 1800, you know, when we're using the Forex LTD, 1400 is 2 o'clock, which is the other time frame you learn about in the mentorship core content. So that's the actual high of the day at the 2 o'clock mark. And you'll learn all the reasons why that's the case. But this is enough for you to find what I promised was bread and butter setups. So if you practice doing this kind of markup on your charts every single day and stay inside the narrative that I'm giving you on the weeks that go by on Wednesday and weekend reviews, stick with that narrative. There's so many of you are still trying to trade, you know, pound Aussie, okay, you know, all these pairs that I don't talk about them, okay, and you're diverting and diluting your attention and missing a very, very valuable learning experience because of the things I'm showing you here. I know that you're looking at these other pairs because you think they're going to offer you more pips or whatever, but you're not getting the high and the low in those pairs. So why are you messing with them? I'm teaching you how to get the high and the low in the euro and the pound dollar, which once you learn, you can do those same things. You just got to do the analysis twice, as I mentioned this past weekend, when you trade those exotic crosses. So anyway, just be mindful when we go over to the cable, this is going to be much more relevant in our conversations. Let's go over to euro dollar. Okay, so here is the euro weekly. And I'm going to throw up levels that I had mentioned before. All right, so we have the high in here comes in at 777 and 5 pip bets. And I gotta calibrate that. Okay, so that's that. All right, and then the top of the gap would be here, but we ate into it down to this low here, but we're just going to keep this level as the only important factor for right now. And let's drop into a daily chart. So you can see we got real close to that level, didn't quite get down there, but we'll see what we get tomorrow with that news. I hope that we get the volatility to jam down in there and at least complete it, and then I don't care what it does from that. But the daily, I want you to take a look at the old weekly reviews this weekend. After you watch this weekend's review, go back and watch all the reviews from the last week of January. Okay, so all of this movement here, this right here, if you look at all of the online forums and all the discussions and such, unless they're students of mine, and you can clearly see they're students of mine because they're looking at breakers, okay, or they're looking at the fair value gap, or they're looking at the bearish order block, and they're drawing attention to that. It wasn't until I actually said, you know, on this particular day, I said, you know, I think this is all fluff, and it just repriced aggressively before it goes lower. And again, don't take my word on it. Go back and listen to those videos, and you'll see that this whole movement here, that was the first quarter move. This is the move here. Okay, so once you understand that this daily chart, it looks exactly like, to me, when I'm looking at a 1 minute chart, when I'm trading the 1 minute chart and I'm doing exercises and practicing or teaching my son, or I'm just showing off by putting them on YouTube or Twitter, it's the same thing to me. Just it takes a whole lot longer for the daily chart to close, and I don't have that kind of patience. So I can work a whole lot inside of movements like this. And I want you to go through every single one of these daily candles and look at the relationship to London and New York, and where the daily high is, what time it formed, and the daily low, what time it formed. All of these candles, okay? You need to be doing that for your first quarter study journal entry for this quarter. All of this movement in here is rich in studies that you're going to find a lot more illuminating when you get through and into the charter member, when you get into price action models and the trading plans. All the things that are in here that you don't hear me talk about in the reviews, like what I'm discussing now, you know what they are at charter level, and you'll be able to go in and see them, like standard deviations, Asian range deviations, central bank dealers range, flout. All those things will be much more impactful, but it's not meant for people that are in here that are under charter level. Okay, so that's why I don't include them. And as you can see, we're already 40 minutes into this in this video, and we're only just now getting to the daily chart in euro. So can you imagine if I was doing all the things on every possible detail? It's overkill. It wouldn't be economical for me time-wise, and you lose your mind because it's too much stuff. Not everyone, because some of you guys are freaks like me and you want to look at everything, but that's okay. Hourly chart, looking at the euro dollar again, we're looking for that 1.0777 and 5 pips. That's the level we're looking to see. Do we have to come back up into this bearish order block, rebalance this fair value gap, and run the simple buy stops here to go lower into tomorrow? Don't know. Like I said, I don't want to be ahead of the monetary statements that they put out in the New York session tomorrow for euro. So again, those types of things. And again, it's late in the week or Thursday. Typically, for your notes, if you haven't written this down yet, if you're new, there's a large degree of probability that the weekly range creates the high or low in Thursday's New York Open. Not always, but most of the time you're going to see that's the case, unless there's some really big driver on Friday for volatility that you see in the economic calendar. That's usually the only outlier that creates the Friday high or low. Okay, so just be mindful. We're going to be pricing in something important for the week tomorrow during the New York session for euro dollars, and what we get, we'll see then. But right now, it's going to be a knee-jerk reaction to whatever they release. Still sticking with the narrative that 1.00775 level is the target. Moving into a 15-minute time frame, kind of ugly. Doesn't really have a whole lot of rhyme and reason in this chart. My eye goes right to here. That's the first thing that I saw when the chart popped up. So that would take us above relative equal highs, which we're already above that anyway. So just be mindful of this level here. All right, so basically 108.15, we'll call that. Yeah, right there. And the reason why I'm going with that is it's still inside the order block that would be bearish, and it also is ahead of the fair value gap, and it might not get to that fair value gap, but that's where my eye went to. So I'm kind of like sharing that off the cuff. If we get there and show some weakness overnight ahead of the ECB, getting to this level here, that's what I'm looking for. I'm not terribly excited. I'm not convinced that it's going to happen. I'm just watching to see if it will. Okay. All right, so let's move over to cable and wrap this one up. Okay, so here's the British pound daily chart. I'm not going to look at the weekly chart because I'll cover that this weekend, and we've been in a consolidation for months now. So I want you to take a look at the lows in here. This is the area I said that we would probably see a draw on liquidity to if we get any kind of expansion on the downside. The low comes in at 28.23 and 8 pipettes. So let's calibrate that. All right, so that could be a draw on liquidity. Plus we have the old low here. Okay, so here's the hourly chart on the British pound. And as you remember last Saturday, I said that we could possibly see it shoot up and run into this high here and this high here. So we have basically relative equal highs. I mentioned that we could possibly do that and then go lower. That's one of the things I was looking for. As you've seen this week, we didn't get that. It didn't go above it. It just made lower, lower, lower. And then we had this long consolidation in here. And I was watching on the 15-minute time frame set up this particular pattern I'm going to show you in a minute. But for now, we're going to look at with that in the chart. scrunch this up. Usually I try to hide all this stuff and just cut right to it, but you're just going to see it. All right, so here we have Wednesday's price action. All right, so Wednesday initially started off with a really chaotic seek and destroy. Now, whenever you see that, they're doing that to clear the board. They don't want anybody in the market before the moves are going to occur. We've seen the dollar raging higher. It just doesn't want to go lower. It's been flexing and flexing and flexing. And finally, GBP had to bend the knee to it. So inside this area in here, I'm going to show you what I saw, but I didn't want to do anything with it until we got into New York. And now think about what I outlined on the dollar index, okay? So here's that recipe for consistency for New York setups. And again, it's just one approach, one facet of the way I teach the content in here, taking specific things, putting them together for a narrative. And when it's in the chart, then you go in and you execute. And if you don't have time to do it live, you at least go back into your charts and you do it by hindsight. And again, that's how I trained myself to trust it before I did it with live money. I had to do this over and over and over again because I was working 13 hours a day. I didn't have the luxury of seeing the chart. All I saw was numbers, okay? And the Quotrek machine I had, which is basically the equivalent of a new iPhone, really the big one. It would be basically that size and kind of like looking like a little transistor radio. I had a little antenna you draw on it. And I had to duct tape this thing to my windshield when I was filling candy machines and soda machines and coffee machines on my route. And I would literally be squinting to see, and the sun would be shining in on the screen. I couldn't see it. And I'm watching the bond prices. I'm watching corn. I'm watching, all these things. And I'm paying a lot of money for the data, and I'm not trading as much to warrant all that. But I was just looking at the numbers, and it would give you the high and the low of the day and then where it was trading at now. And I had to keep track of, like, every 30 minutes, did it go above an old high that I kept a note of? And on my truck seat next to me, there'd be a pad. And whatever market I was watching, I would be writing down the highest high I remembered in the last 30 minutes. So I was visualizing, like a floor trader would do in an open outcry pit, what they would be doing. And they would write down where they were in relationship to the last 30 minutes. When it made a new high, they would mark that. And because they would see the flow of orders coming in and interest of buying and selling, they really had the order book, if you will. Okay, so open outcry doesn't exist anymore, but the same dynamics are present in price delivery. So what we're looking for is the cable to go lower. The first idea I mentioned on this past weekend is I wanted to see it run above that high and then go lower. If it did that, we would have what I was outlining last week, and also referring to how I viewed the S&P. And then when it had its break and it showed the imbalance with the fair value gap, then you can go in. That's your setup. You can go short there and look for a liquidity pool to cover below an old low. Same premise. Think about that, how I used and referred to the S&P in last Saturday's example, where I said, okay, here's a level I was looking at. I tweeted it, but it didn't give me the setup until the very next day. Then the setup formed. Okay, so that's what I mean by knowing what you're looking for, not being irrational, not being impatient, being objective about what it is you're trying to do, and waiting for the market to show its hand to you. It can't hide, okay? It doesn't hide from you, okay? It hides from you when you don't know. Prior to being exposed to what I'm teaching you, you don't have any idea what's going on. You don't. You're looking at continuation patterns, harmonic patterns, supply and demand crap, all that stuff. And by the way, I just saw somebody sent me something. If you guys are aware of this, let me know. Apparently, Online Trading Academy is being attacked, if you will, by the FTC. That's not good. So Sam's and his bunch over there are apparently done themselves a poor showing. Apparently, maybe they've been advertising, people making money and whatever. But I know they charge like $50,000, and you guys are complaining sometimes when you get in touch with me on email. You can get a discount. It's already a discount. $2,000 is not a lot of money if you really think about it. But there's other people out there that are running these like college degree level costs $50,000, and they don't know what I'm teaching you. Okay, believe me, they don't know how to get the high and the low of the day. They don't know how to do this stuff. Okay, none of them over there do. I'm convinced that some of them are in here, and I don't know how to prove that, but I have also members in here that are part of the Online Trading Academy, and I'm waiting for them to, if they see my stuff there, they're going to tell me about it like everybody else does. But anyway, the FTC is apparently suing them for fraud or something. I don't know what they're doing, but anyway, I'm ready. If anybody wants to talk to me, I mean, I got records of this stuff. It's happening after I say it, and everybody in here understands when they come in here, they're learning price action. So I'm teaching you how to read the price. We don't talk about taking live trades. All that stuff's encouraged by them over there, and people like them, and that's how you stay out of the trouble. You never get yourself in trouble if you don't promise people profits. Okay, that's why I always say demo, because it's a protection. Okay, it's a safety net, not only for me, first and foremost, because there's a lot of people out there who just do stupid stuff and then say, well, this is my fault. He told me to do this. He said in a video that if it does this, it works every time. Well, I don't say that. There's nothing ever is 100%, and you'll lose money eventually. If you trade with live funds, you're going to lose money. That's a guarantee. You're going to do it. How often and how much, it's up to you. And most people lose their mind when they lose $25 and it becomes a $1,000 loss by the end of the day. So it's part of the game. And if you're getting ready to start a service of your own, okay, just be mindful that you got to be really, really careful, because these agencies are vindictive. Like they're just nasty, and they have unlimited resources and money. They can keep going after you and after you and after you. And that's why I go the route of the demo baller. I don't care what anybody says, because it ain't worth all the trouble. So anyway, the British pound, we have initial seek and destroy scenario, and we have liquidity pool here, and let's put that in here. So we have resting below here. What's that? Sell side liquidity. Okay. Sell side liquidity resting below here as well. We don't need to note that. But I want you to think about the price action right in here. Right in there. All right. What do you see? Right now you want to pause the video, because I'm giving you an opportunity to think about what it is you think you see, and then I'm going to show you what's there. All right, if you haven't paused it, I'm ready to start talking about it. All right, so we have the bearish order block right here. I'm going to put it past it a little bit, right there. All right, and that's the open of the body, and then we have the tail down here. So we have, this is our bearish order block right there. Right there. Okay. So the market trades up in basically consequent encroachment of the wick or tail of this bearish order block. That price is a good price to sell at, the 50% level. Okay. Who cares about that? Because you probably wouldn't have taken that, and I'll explain why. When we drop down into a 15-minute time frame and elongate this. All right. So inside of that tail of that bearish order block on the hourly chart, that's this range here to here. What do we have inside of that? We have a small fair value gap in here, and we have the order block that is more refined. So it's the last up candle, big beefy candle versus all these over here. Why aren't you using these last candles over here, Michael? Which one has more volume? And the way you know that is by the body. Okay, the body of this candle is much larger, much more prominent than any other candle over here except for this one, but that's not part of the swing high. Swing high's over here. So you're reducing your time frame and focus down from a hourly chart to the 15-minute time. So now 15-minute time frame gets calibrated to, this is your order block here. there. Okay, so you have the butt end of that candle's open to its little tiny tail right there. Okay, so you're going to be a bear here. Now, on a day like this where we have relative equal lows and relative equal highs, all in this consolidation, it drops down, puts people in going short on a breakout. Okay, they're short. Where's their stops? Above here. So what does it run? That. Then now it's at target even higher? Not yet. It goes lower, neutralizing these individuals. So nobody's making money, and then they run it one more time here at 4:30. Hits it, makes the high of the day, breaks down, creates a lower low. And then I tweeted and showed you that it started the day with a seek and destroy scenario. When you study my core content and we talk about profiles and seek and destroy, you know, based on what they're running and what they run first, what that narrative is. We have a strong dollar in all this. So what's it likely to do? Probability standpoint, go lower. Do you just go low, go short looking for lower lows because the dollar's going lower? No. You have to look at what I teach. Okay, now watch. Here's your SIBI, sell side imbalance, buy side inefficiency. Right there. Okay. This candle's low, this candle's high. Price goes up, consequent encroachment, midpoint of that. That's not supply and demand. That's not Chris Lowry stuff. Okay. It's ICT. ICT. Yeah, I know. Price expands to the downside. Immediate rebalance here. Look at that. Nice big beefy candle. Opens. Boom. Immediate rebalance. Go back and look at your weekly commentaries and you'll see that there's a lesson on what that is. And I just recently talked about it too. And I think it's in the last, if it wasn't Saturday, it was the week before or midweek review. It was mentioned in there. But we'll talk more about that too because it's not done. But immediate rebalance and then distribution. Okay. Doesn't quite give you institutional intradrill for this, for the high 29.61 and 9, and yeah, it went to 59. So we didn't quite get above or at that candle's high before the next sell off. We did get a fair value gap in here. Price hits that, and then distribution running below that old low. And this low here. So big distribution, another level distribution here. And I want to take you into the 5-minute chart for this pair. And we'll look at the New York kill zone and then we'll be done. So here is 7 o'clock in the morning today. And here is 10 o'clock. I don't know why I do that. To 10 o'clock. Okay, so we have the high in London, that's our reference point, bearish because the dollar's bullish. The market has broken down, broke the lows, and now we have a retracement. Okay, and we're inside of the New York kill zone. So from the high to the low, here's 50. Trades right to the 50 level. That's your PD array matrix. Okay, it has to trade at the 50 level or higher. If it doesn't do that, you can't sell short because it hasn't gone to a premium market. It's a premium market here. It's also closing in a SIBI on the 5-minute chart. So all of this movement down here creates an imbalance to the downside. So the price is going to want to rebalance to that price point, also trading at the 50 level inside of the time of day, which is the New York kill zone. Okay, so we have this fair value gap in the form of a SIBI, which is again sell side imbalance, buy side inefficiency. Okay, for the new people here, that means price was too aggressive going down for this particular time frame. It was too fast going down, and there's not been any up movement since it created that one single candle. Okay, so you see it do it here, all in here. It doesn't quite all the way come back to the top. Just barely falls short of it, but look how much time it allows traders that know about what I'm teaching, which is not institutional Goldman Sachs. Okay, it's not UBS. Okay, it's the people at the central bank level. If folks don't believe that they're not doing their own trading and speculating, it's foolish. You're just completely oblivious. It's greed. Okay, this world spins on greed. Everybody's doing something to get $1. Okay, they're either trying to make $1 or trying to save $1. That's the number one motivating factor that makes this world go around. Like it or not, that's the way it is. And believe me, the central banks are in control of these things. They're in control of price. And you think they're just in the business of making monetary policy for the sake of managing an economy for our country and no profit from it? Get out of here. Come on. Get out of here. This is the way it works, folks. Okay, it has nothing to do with harmonics. It has nothing to do with supply and demand. It's all money. It's money. Where do you find it? I'm showing. So here's your distribution cycle that begins in the New York Hill Zone. Now we want to see what? All up close candles to provide resistance, because it's going to act like bearish order blocks. And down close candles, we want to see price trade through them aggressively. Okay, we want to see price. Here's an up close candle. Let me get this out of here because now it's getting too busy and I want to get distracted. Elongate this a little bit. All right, so we have this up close candle. Price returns back to it. Does it offer resistance? Yes. Down close candle. Does it get trade through? Yes, it goes through that. So now we have this up close candle or series of up close candles. If price returns back to it, does it offer resistance? Does it repel price? Doesn't need to get back to it apparently there, and trades lower. We have up close candle here. You're going to see a theme already. Up close candle, price gets back almost to it, then falls short. Does that indicate a strong market or an exceedingly weak market? Because we already have two reference points here where the market was unwilling to get back to what would otherwise be seen from people that just know my free stuff. It didn't get to my bearish order block. It just missed my trade. It didn't give me my fill. Right. But it's trading into the fair value gap here. Again, all these people on YouTube making videos and they don't know what they're talking about. Fair value gap. Perfect. He's always got an answer for something. I'm ICT, of course I do. Fair value gap. And right in here, immediate rebalance. Doesn't trade back to here. It doesn't need to. Here is your fair value gap. It starts on the open on that candle right there and comes all up there, boom, hits into this wick. Okay, inside this wick. Let me take this off and you'll see what I mean. This is what I'm talking about. There are several things you're watching when you're looking at price. Everything that acts as a discount or a premium, you're going to consider. And based on how price trades to it, and this is the level of experience. There you go. Trades up into the 50 level. Boom. Consequent encroachment on the tail. And again, I taught that also in the commentaries. It's not just the lessons above each month. Okay. When you do the commentaries with me each week, I'm taking the things and I'm placing them in the chart, or I'm using them to deliver my opinion. And then I talk about after the fact and say, okay, this is the reason why I did it. Too many people in the beginning, the first group, were like, oh, he's making stuff up. Because they were convinced before they even started to really study with me that this was all make-believe. Okay. And I didn't know how to trade. I didn't know how to do anything. Couldn't call market. Now these same people are trying to get back into the mentorship, okay? And they went like month 2 or month 3. I'm talking about the 2016 folks. They're like, oh man, I really want to get back in. I made a mistake, blah, blah, blah. Okay, start over, because that's the way it works. And we don't do rejoins here. So if you ever feel like you're lost and you feel like you're just not getting it, just keep going. Okay, just keep going. I promise you, it's so much information, especially when you get to month 5. It's so much stuff. Month 5, I kill you. I probably should have had like month 5 split up into 3 sections because it's too much stuff. But hey, that's when the real stuff hit, because the first 4 months is just kind of like a rehash of Sniper series, Market Maker stuff, all that stuff. It's just kind of making sure you understood the main things from those series. And then month 5 rather of the mentorship, that's when it really starts hitting it and pulling things together. But anyway, the market breaks down, relative equal lows, expands below that. Here's that old low, and then we aggressively move below that. We have an imbalance created in here. Fair value gap, bearish order block overlap. I love that setup. And then expands sell side liquidity here. And fair value gap here, trades up into it there. Distribution runs lower, and there you go. So the main takeaway is, here's that New York setup. And as I outlined on Twitter, fair value gap here. Order block on the dollar. You only need a pairing like that, one or the other. Now, it could have been the fair value gap on the dollar and a bearish order block on the British pound. It's just pairing up specific PD arrays, okay, a premium array with a discount array in opposing currencies. With the dollar, we're expecting to go higher. That's our barometer. That gives us our directional bias, or the structure in which we frame our trades. Okay, that tweet I gave today, where I said 80% is deciding why the market should move. Well, that's what I talk about. That's all the long droning on that I give you in the video. That's what that is. That's the part that you're not getting from my free videos. You're not getting that from other educators, because they don't teach it. And I'm convinced because they don't know it. I talk about these things to allow you to retain it, because it's so repetitive. As much as you want to hate hearing it again, it's important. And you want to be watching these videos again. It's scientifically proven that our brains have little nodes at the tips, okay? And our memories more or less break off. Every 7 years, memories start to lose resolution, and retention is lost. And that's why you have to go through these things to keep your skills honed. People that do really well in sports, if they take 7 years off of it, they're not going to be as good as they were. People that go to the gun range, okay, or Olympic shooters, if they take a break for 7 years, they're not going to shoot as well. They'll still be better than the average person, but they're not going to have that edge they've had. They have to keep their edge, but that doesn't mean use their edge every single day. Okay, so there's a balance that has to take place. Actually, I learned this from one of my favorite Bible study teachers, Chuck Missler, which he's gone on to be with the Lord now. I learned it from one of his Bible studies. He's very scientific. He's very, he comes from an information background like me, and he has a very scientific and lofty opinion of the Word of God. And I'm not preaching to you, I'm just telling you where I got it from. But the idea is that you have to constantly read the scripture to retain it, because every 7 years you're going to forget. So you always have to constantly go in there and wash yourself with the word. Well, this is the same way. You have to go in. I'm not trying to equate my teachings to the Bible. Don't get me wrong, because there's a lot of people say I'm a cult leader. But it's the fact that I know how the brain works. And certain things that you don't want to listen to or do are the very things that's preventing you from getting good at this. And you have to listen to the theory. You have to listen to the conceptual arguments that I give, because I'm beating down barriers, but some of you want to hold them up. And by doing so, you're holding yourself up. So in other words, you're holding on to treasured opinions from people you've either learned, and I did this for years. Okay, I mean, I had authors that I was like, oh, this is really good. This is really good. Like, I championed Alexander Elder for a long time because of his triple screen, because it was a big deal to me. But when I talk to other people online, they're like, everybody does that, dude. What are you talking about? That's top-down analysis. But I was new. I was a fledgling. So I wanted to get out there and beat my chest. I was smart. I figured out something because I didn't know that from Ken Roberts. He was just a narrow sideways channel breakout guy and a 1, 2, 3 top and bottom, which never worked out for me. So when I started looking at larger time frames and breaking them down, I could see it in the past. The problem is I could never make it work going forward because the indicators are distracting me from what was really going on. So anyway, that idea of 80% of knowing why the market should move, that's what these weekly reviews are. And that's the mentorship. You know, I could literally put what you should know by concept, okay, in bullet points, and literally put it in a PDF and tweet it this weekend. And it would literally be useless to everyone that reads it. Now, people that are chart members are like, you just gave the mentorship away. It wouldn't be like that at all. It literally, like I said, I could put this stuff on the USA Today, or what's it called, the US Today? What's that newspaper called? I can't think of it now. I only read Investors Business Daily. Okay, I could put it on the New York Times front page, okay, or a big full page splash and say, this is how you trade the foreign exchange market. It works every day. And people would like, what is this? And turn the page. But it's only until you go into the charts, which is what I force you to do. So you're all listening to this one moment where I say, okay, cable's going to go to this level. Okay, that's it. I'm done. I don't need to hear anything else. And you're not learning. You're growing attached to codependence. And I don't want you to do that. I lecture you all because I'm envisioning my children. So you guys know the internal dialogue. I'm actually picturing Cody. I'm picturing Caleb. Okay. I'm picturing my children, all of them, in my mind as I'm talking. And that's the reason why it sounds like I'm talking just to you in this video, because it's the way I'm delivering it to you. I mean what I'm saying, and it's a fatherly love. I'm talking to you because you're my son. Okay, you are hopefully going to carry this on in the future, and children I'll never see in my family tree will hopefully learn from these things. The folks that are in the mentorship that paid to be here, they are just guests and they're benefiting from the conversations that I'm having with you. So this is kind of like that Michael Keaton My Life movie. Okay, something that ever happens to me, God forbid. You know, I have made a catalog of things that would otherwise be gone forever because there's no other resource outside of me that has this. And that's why I do what I do. Now, I know years from now, my stuff's going to go all over the place because it's already happening now. And it's being diluted and renamed and repackaged, and all these 20-year-olds, you know, and failed traders before, now all of a sudden they're, you know, got something that works. They're not telling you what made them different because it just takes them right back to me and they don't have a voice anymore. But I know that if you listen to the things I talk about and get your mind focused on the things that are barriers so that we can beat them down and overcome them and avoid the other things, you're going to see if you do those things, which doesn't feel constructive. It doesn't feel like that's the best use of your time. Like, this video is very, very long. And you're probably saying, you could have said all these things in a 15-minute video. You don't respect my time, Michael, and this is ridiculous. And I'm not respecting your time because that's not why I'm here. I'm here cataloging this for my children, and I made it available to you. Just be thankful. Glean what you can get from it. And I'm telling you, this is the very thing that I had to do. Everyone that's ever learned from me that has found consistency in this has done these things. The ones that didn't do it for the first couple years and resisted it did their own way, okay? Try to put their own little spin on, I like the order block, I'm going to put it in here, You don't know what you're doing. None of you know what the full order block theory is or what it's capable of giving you. None of you know that. You have a snapshot of what it looks like when it's good, but you don't have the depth of it. And you'll learn that over time. So with that, I'll talk to you this weekend. Wish good luck, good trading.